Quick question. If I told you that a single $500 deposit, one deposit made once today, could turn into almost $27,000 by the time you retire, would you believe me? And considering what we do here, I hope that you do, because this isn't a trick. It's not a secret that the banks don't want you to know. It's just math, running quietly in the background for 40 years. Today, we're pulling apart exactly what happens when a 25-year-old invests $500 a month, every month, until they're 65. And by the end of this video, you're going to understand not just the destination, the millions, but the actual machine that gets you there. Because once you understand the machine, you stop needing motivation. The math does the convincing for you. My name is Richard, and welcome to Ronc Industries, where we're pro-wealth and pro-growth. And in this video, we're looking at what actually happens when you invest $500 a month over the course of 40 years. Now, I want to be upfront about something before we dive in. There's a written piece on the site that goes deep into every number, every table, and every scenario. The link's in the description if you want the full data dump. But this video isn't going to be that. This video is the version where I take the same factual foundation and we walk through it the way you'd explain it to a mate over coffee. Same facts, but an easier path to understanding them. So let's start with the punchline and then work backwards to how we got there. So a quick pause before we get back into compound interest and the real cost of starting late. Markets have been compounding wealth for over a century, and the data is clear. The direction is obvious, but knowing the destination doesn't tell you which vehicle you should get in. Shares, property, and business, they all work, but only when they fit your capital, your timeline, and your risk tolerance. Get the vehicle wrong, and the math we're about to show you stops working in your favor. That's exactly what the Wealth Strategy Masterclass helps you sort out before you commit a single dollar. If you're starting to think seriously about where your first investment actually goes, this is the framework you need to work through before someone else makes the decision for you. Register with the QR code on the screen now. Right, back to the machine that turns $500 a month into 1.5 million. So here's the number that you want to know. A 25-year-old who invests $500 a month every month over the course of 40 years, earning a long-term average of just 7.5% a year, ends up with $1.52 million by the age of 65. The total money that they actually put in across that entire 40 years, just $240,000. So roughly 1.28 million of that final number, over 5 times what they contributed, is pure growth. Money that the money made, not money that you made. Here's the analogy that I want you to sit with. Imagine you plant one tree, you water it consistently for 40 years. You don't dig it up, you don't replant it somewhere else every time you get nervous, you just let it grow. That's a forest. The tree didn't even need you to do anything heroic. It needed you to get out of the way and not interfere. And here's the part that should really land. If the market does a bit better, say 10% instead of 7.5%, that same $500 a month becomes 3.19 million. Now, this is the same contribution, the same person. The only difference is that the rate that the forest grows at, which is mostly outside of your control. What's inside your control is whether you plant the tree at all. Now, I want to zoom in on something most people skip past because it's the single best argument for starting today instead of next month. The first $500 you ever put in, the one deposit in week one, year one, by itself with no more contributions, just sitting there compounding for 40 years at 7.5%, grows to $9,950. At 10%, that same first $500 becomes $26,850, 54 times its starting value. And that's just a 2.5% improvement on the rate of growth. Think about it like a seed versus a sapling versus a tree. The $500 you invest in year one isn't just $500. It's $500 plus 40 years of runway. The $500 that you invest in year 39 is just $500 plus 1 year of runway. The same dollar amount, completely different destiny, purely because of when it was planted. Now, this is why "I'll start when I have more money" is one of the most expensive sentences in personal finance. It's not the size of the seed that matters the most, it's how early you can get it into the ground. Now, I say this every time because the comment section will absolutely potentially come for me if I don't. Someone is about to type, "Yeah, but $1 million won't be worth anything in 40 years because of inflation." Well, that's correct, sort of. Let's deal with it properly instead of pretending it doesn't exist. Markets have historically returned somewhere around about 10% a year before inflation. Inflation, on average, officially, runs at around about, say, 3 to 4%. So your real purchasing power, what that money will actually buy you in today's terms, tracks closer to around about, say, 7 to 7.5%, the figure that we used earlier. That's exactly why I gave you both numbers through this video. The 7.5% scenario isn't the pessimistic one, it's the honest one about inflation. The 10% scenario is the raw, uninflated number history has handed us. So we use 7.5% when you're thinking about what your future self can actually buy. Use 10% when you want to understand the raw power of the market. Here's the analogy. Imagine you're filling up a bucket with water, but the bucket has a small, slow leak. That leak is inflation. You don't stop filling the bucket because it leaks. You just make sure you're filling it faster than it's leaking. Historically, the market has filled that bucket a lot faster than inflation has drained it. And that's the entire game. And here's the number that should bother you a little. If you sit on cash instead of investing it, even for 10 years, at 3% inflation, that cash loses close to 27% of its buying power. Doing nothing isn't a neutral move. Doing nothing is a guaranteed loss, just a slow and quiet one. And this is before we even try to second guess what the economies could do into the future with things such as quantitative easing. Now, this is the section that should make you slightly uncomfortable, but in a useful way. Let's meet three people. All of them want to retire at the age of 65. All of them invest $500 a month. All of them get a 10% average return. Investor A starts at 25, 40 years of contributions. The final number, 3.19 million. Investor B starts at the age of 35, 30 years of contributions, final number 1.14 million. Investor C starts at 45, 20 years of contributions, the final number only 382,000. Now look at the gap between A and B. B started 10 years later. You'd think that that would cost them roughly a quarter of the final balance. 10 years out of 40. It doesn't. It costs them nearly 74% of the final return. Investor B ends up with less than a third of what Investor A has for being a single decade behind. Now, here's the analogy that I think nails this down. Imagine two people running a marathon, but it's a really strange marathon. Every hour you're in the race, your running speed doubles. Investor A starts with the gun. Investor B shows up 10 minutes late. In a normal race, 10 minutes is recoverable. In this race, because the speed compounds, those 10 minutes at the start are worth more than hours of sprinting at the end. That's compound interest. The early minutes are not equal to the late minutes. They're worth much, much more. This is the single most important takeaway in this entire video. The cost of waiting isn't linear. It's not I lose a bit. It's I lose the majority of my outcome for a delay that feels in the moment completely reasonable. The most valuable thing to do is to simply get moving and to make that first move. Now, 40 years is a long time to stay disciplined for a payoff that you can't see yet. So let's give you something nearer term to aim for, a milestone that actually feels good along the way. There's a specific point where your portfolio's own monthly interest earnings overtake that $500 monthly contribution. This is the point where your money starts out earning you. At 7.5%, that happens around year 12. At 10%, it happens before year 9. I've put a download link to the tool in the description below. Think of it like hiring an employee who works for free, never complains, never calls in sick, and who within about a decade starts out earning you on the very job that you originally gave them. By year 9 to 12, you're still putting in $500 a month by hand, but your portfolio is quietly throwing off more than that on its own every single month without you even lifting a finger. That's the moment this stops feeling like sacrifice and starts feeling like momentum. Mark that year on the calendar. It's a lot more motivating than 40 years from now. Now, I'm not going to turn this into a stock picking video because that's not what this is about. The 7.5 to 10% return ranges we've used all video so far are broadly consistent with simply tracking the overall markets, namely the average return of retirement funds, and then something like the S&P 500, which has a calculated compound annual growth rate of about 12% between the years of 2010 and 2025, or just a total market index fund on its own. You're not trying to find the next big winner. You're trying to own a small slice of everything and let time do the rest of the work. But it has to be stated that there are investments with higher rates of returns, sometimes in the order of greater than 50% between 2014 and 2025, even with the potential risk that does come with some of the significant drawdowns that make these numbers of 7.5% and 10% look soft and doughy by comparison. The mechanism that makes this realistic for an ordinary income is dollar cost averaging, an automated transfer, same day, every month, buying in regardless of whether the market is up or down that week. You're not trying to time the market, you're just consistently present in it. And every number in this video has shown you consistency beats timing every time. Now, the last point, and it might be the most important one for a lot of people watching this. If you're 25 with an entry-level salary and your rent is eating half your paycheck, $500 a month might genuinely not exist in your budget right now. So don't let that stop you from starting. Instead, start smaller and build the escalator. Say, start at $150 a month and increase the contribution by just 5% every year as your income grows. By the end of 40 years, you're contributing $910 a month, and the final number still reaches $1.8 million at 7.5%, or $4.07 million at 10. Push that annual increase to 10% instead of 5%, and the same $150 starting point produces over $7.5 million at 7.5% and $17.7 million at 10%. So let's read that again. Starting small with consistent, modest pay rises directed into your investments can outperform starting at $500 flat because your contribution grows in step with your career instead of staying frozen at today's number forever. The barrier to entry isn't $500. The barrier to entry is simply starting. So here's everything in this video distilled into one idea. Time is the asset doing the heavy lifting, not the size of the first contribution. Start as early as you can with whatever you can genuinely spare, even if that's $150 or $500, and increase it whenever your income allows. If this broke the numbers down in a way that finally made sense, please do me a favor and hit that subscribe button, share it around, and check out the full analysis at roncindustries.com/finance. Thanks for watching. I'll see you in the next one.